United States. And what we are seeing on both sides of the border is what looks like weaker than expected performance. How much of that is a consideration of this trade uncertainty we've been talking about? And more importantly, where's the economy going from here? Let's kick off our programming this hour with two people who think a lot about these issues. Charles St-Arnaud is chief economist with Alberta Central. And joining us here in studio is Jim Thorne, chief market strategist at Wellington Altus Private Wealth. It's great to have both of you with us. Charles, I'll start with you and what you make of the Canadian jobs numbers out today.
Yeah, well, I think it's a bit of a disappointment to see some weak numbers, but I think we need to be also putting them in the context of how strong the labor market had been over the past few months. We've had 3 consecutive months of very strong and surprisingly strong growth. So how much of today is just a return to normal and some kind of mean reversion rather than actually something that should be worrying?
I guess, Jim, the context on that would also be that we're in a worrying time. So as we look ahead, I think there's been a lot of uncertainty about what will happen in the employment picture. What's your sense on what's happening with the Canadian economy right now?
Well, I think the Canadian economy continues to slow. I think the Bank of Canada needs to cut. I think they're behind the curve. And a majority of the job growth that we've experienced over the last period of time, both in the United States and Canada, has been driven by unsustainable government spending. So the private sector is contracting in both countries, and we need to basically get ready for a growth scare in both the United States and Canada.
Charles, we saw in at least some of the trading circles expectations for a Bank of Canada interest rate cut next week rise after this jobs data today to around 85% of the street essentially thinking that we'll see a 25 basis point cut. Do you think we'll see the Bank of Canada cut rates next week?
Well, I think it makes sense for the Bank of Canada to cut next week. We know, especially given the extreme level of uncertainty right now, it is not a business environment that is really helping investment or even consumers to be spending. So we know the economy is going to be weaker just because of that extreme uncertainty. So it makes sense for the Bank of Canada to start cutting now and can get ahead of the actual negative shock that we'll see might come in April.
And Jim, I wonder if we were sitting here on this Friday morning and we didn't have like a reprieve or a stall on some of the tariffs that were implemented earlier this week, would your framework be different this morning? Would you be feeling more concerned about the outlook for the economy? In other words, what's your takeaway on where we've landed on the trade front when it comes to the economy on this Friday morning?
Right. John, I lived in D.C. for 15 years, and one of the things you learn quickly with respect to President Trump is you take him seriously, but you don't take him literally. So if you look at the data, his arguments don't hold up. So I would still suggest that, and Tiff Macklin said this on the record, that monetary policy has an 18-month lag. They're behind the curve, and a cut today will not be felt for 18 months. Right now, the economy in Canada is dealing with 5% Bank of Canada rates that were set 18 months ago. So as investors, you have to look out 5 to 6 quarters. And so the real question for us at Wellington is, we think interest rates, the overnight rate is going to get significantly below 2% in 2026. So they should continue to normalize.
And Charles, earlier we heard Jim talking about the fiscal picture in both Canada and the U.S., which I think coming into this year was a concern for a lot of people. And yet, because of the way things are playing out with the trade war, now we're talking about how much fiscal firepower, for example, Canada has at a federal level, at a provincial level. What's going to be the balancing act on that? Like, if you're trying to determine where the economy goes, and as Jim says, there's a lag with interest rate policy, if we're going to throw some money at the economy in the short term to assist, depending on how things play out, what's the balancing act on the fiscal front?
Yeah, well, I think on the fiscal front, what's really important to keep in mind is that it is not the same situation as COVID. We know during the pandemic, there will be a big drop in economic activity and then a rebound. With a trade war, there's no rebound. So it changed your way you can put your support. You cannot do the same type of blanket and income replacement that we've had during the pandemic. So you need to be a bit more targeted, and also to realize that if you start doing support, it might actually end up being more permanent support than what you did during the pandemic. So you have to think about that in terms of what is the impact of the fiscal on your fiscal side in the long term. And it's very important that you need to direct that support more towards improving competitiveness rather than just replacing the income that has been lost.
Meanwhile, if we want to just sort of turn our focus back to the U.S. for a second, Jim, and, everybody says, well, Donald Trump, he's always got at least an eye on the stock market, even if he's dismissing that this week amidst the volatility. Do you think he'll have an eye on these jobs numbers today? Do you think he'll look at worries about a moderating economy and put that into a consideration with wherever this trade war goes from here?
Scott Bessent has framed this, the Secretary of the Treasury has framed this as the first 6 to 12 months. It's going to be the Biden economy. So I really think that President Trump and his administration are going to front-end load these structural adjustments. And where I differ from consensus is the fact that it's not about the trade war. It's the fact that the Americans have come to the realization that the post-World War II global trade structure is no longer sustainable, and we need to go through massive structural adjustments. And that's why I suggest that the Bank of Canada and the Fed have to get rates down, because we're going through a major structural adjustment period. This is not about tariffs.
And Charles, for now, final word over to you, because Jim was talking about maybe not being surprised, I don't want to put words in his mouth, to see rates getting in Canada towards 2%. I guess we're around 3% right now. We started this rate cutting cycle around 5%. As we look through the year, and maybe we'll get more clarity from the Bank of Canada next week, how much additional rate cutting do you think ultimately we could see from the Bank of Canada?
Well, I think we'll see a lot of rate cuts this year. Like even before the trade war and the tariffs, we knew we had a neutral rate in Canada that was gradually sliding lower throughout the year because of the slowdown in population growth. We're going from population growth of 3% to close to 0 by the end of the year, if obviously the target from the government are reached. So that will drag your potential growth and drag your neutral rate just naturally. So with that, you already have that big current undercurrent, and then add the trade war that will have an impact on our exports and on the economy in general. So we could easily be below 2% by the end of the year. I wouldn't be surprised to see maybe 1.5%.
1.5. Okay, well, a lot to watch for then. Great to get your perspective. Charles St-Arnaud, Chief Economist at Alberta Central, former economist at the Bank of Canada, and Jim Thorne as well, who's going to stay with us